Here's why big companies like this one won't be buying your home and will likely be selling off the ones they already own. It's about time we got rid of these guys. So Blackstone has stopped buying houses in 38 cities, including some of the markets where they've been most active, like Boise, Idaho, and Memphis, Tennessee. So you're probably wondering why. Why are they dropping out of these markets that have been red hot over the last couple of years? Well, Jerome Powell gave institutional investors some bad news the other day. You can see here the current federal funds rate is between 2.25 to 2.5%. Well, the Fed intended on increasing that to just below 4% all the way through the end of 2023. This is a clear sign there's going to be no interest rate relief for the next year and a half. And you're probably wondering what that means and how it will affect the big home buyers. Well, these investors have been making an average capitalization rate between 4 and 6%. And that's just a fancy way of saying they make between 4 and 6% cash flow profit annually on their real estate. Well, if these big investment firms can simply buy a 6-month treasury bond and get nearly the same return without any of the risk, guess what they're going to do? They're going to be motivated to sell off their inventory that makes the worst returns and find other investment vehicles. Now, just like everything else in real estate, this is market dependent. This won't push out institutional investors from every city, but it will in a lot of them. And it will still put added pressure on these investors in the markets where they continue making enough profit to make real estate investing worth it. There's another elephant in the room too that nobody is talking about. We all know that the thing that largely killed the housing market in 2008 was adjustable rate mortgages. Well, guess what? When these massive institutional investors go out and buy $1 billion in real estate, they aren't using their own money. They are usually only putting down 25 to 30% of the money used to buy these homes. The rest is borrowed. And those loans often have an adjustable rate. Meaning just like the adjustable rate mortgages that left individuals unable to pay in 2008, properties that these investors own that were once profitable just a couple months ago could become money losers. And at that point, the bank will do what's called a margin call. This is where these investors will be forced by the banks who lent them money to sell these losing properties. This will dramatically affect these cities that have had massive investor buying and that have low cap rates. And this is no small number of homes. To give you an idea, investors bought over 18% of homes in the fourth quarter of 2021. And they have been purchasing as much as 30% of houses in markets like Charlotte, Atlanta, Jacksonville, and Phoenix. And these high interest rates have already started affecting home prices. For the first time in 3 years, home prices fell last month. They went down 0.77% in a single month between June and July. Now, you may not think that a single month of declining house prices is a big deal, but you have to understand this number in context. This is the biggest drop in a single month for home prices since 2011. And to give you an additional idea of just how bad that is, it is the worst price drop for the month of July in over 30 years. Now, a single month of dropping prices isn't such a big deal, but Black Knight projects that further price drops can be expected as we move into the slower part of the year for home sales. Something to keep in mind is, even with this drop in prices, the housing market is still unaffordable in many major markets. You have to remember that for every 1% that the Fed adds to the interest rate on a mortgage, your payment is going to be roughly 10% more each month. So we really need to see some declining prices in the housing market to even compensate for the recent rise in interest rates. And I'd still argue that most people found the housing market unaffordable a year ago when the interest rates were over 2% less than what they are today. The good news is, because of the increased federal funds rate, we are going to see much less speculative investing and an eventual return to home affordability. So you're probably wondering how you can know when is a good time to buy. And this is a difficult question to answer. Each market behaves a little differently, and sometimes there's new influencing factors like large companies moving into a city and bringing a bunch of high-paying jobs. But I feel like there are ways to keep your fingers on the general pulse of the overall market, which can be a strong indicator if it's a good time to buy or not. So here are certain things that I look at and will be keeping you guys updated on in future videos. Housing affordability, or the percent of the median household income required to pay a monthly mortgage, is a big indicator. This is a great one because it takes into account home prices, mortgage rates, and wages. These are three of the most important influencing factors to a home's price long term. So the long-term average is 23.5% of a household's monthly income goes to a monthly mortgage payment. Okay, that's what it should be more or less. Today, the percent of median household income that goes to a mortgage is 32.7%. That's 39% more than the long-term average. If that doesn't spell out a massive housing bubble to you, maybe this will. Housing affordability is at its lowest level in 30 years. Now let's cover the top 6 housing markets that had the biggest drop in home prices over the last few months. Number 1 on the list is San Jose, California, with a price drop of 10% in the last few months. That really comes at no surprise considering it was one of the top 3 most expensive housing markets in the US. And we know that many people who live in that area work for some of the largest tech companies, which all took a big hit in the stock market. Seattle was next to have a drop of 7.7% in home prices. That's another tech-heavy city that's had high home prices. Also, Seattle has really struggled with an increase in homelessness over the last couple of years. I personally know people that have left the city largely because of this. Now, San Francisco had a 7.4% decrease in home prices. I don't know if you're catching on to the trend, but these tech-heavy cities on the western side of the country that historically have had really high home prices are seeing the biggest drops. Then San Diego had a 5.6% decrease in home price. I think that one went down largely based on affordability compared to local earnings. Now, Los Angeles went down 4.3%. California's beautiful weather, but their big cities are almost all having massive issues with homelessness and crime. And then there's Denver with a drop in home prices by 4.2%. This one surprised me a little bit. Denver homes are expensive, but not as outrageously overpriced compared to some of these other larger markets. Now, even with these price drops, there was still a 14.3% price growth between July 2021 and July 2022. And with the increase in interest rates by roughly 3%, the monthly mortgage is still around 40% more expensive on average now than it was a year ago. With that in mind, prices would need to drop significantly for homes to be affordable again. But this is what I would say. It never goes up forever. And the scenario now is very different than it was even 3 years ago. The inflation prevents the Fed from performing monetary easing. This is why the interest rates are going up and why the Fed plans on keeping them up for the next year and a half. With home prices the way they are, the Fed has no interest in buying up mortgage-backed securities. If anything, they are inclined to sell them off. Now, it's not all roses. I do think that institutional investors have become greater competition in the marketplace. It used to be much more difficult for them to compete in all these individual local markets because the data just wasn't as readily available and as frequent. Now these institutional investors can evaluate markets much better from a desk on the other side of the country. And it's not that once investors sell, they are out for good. That's not the case. They may stay in specific markets that make sense for them. And in markets that have a crash, they will view that as a buying opportunity, same as you. So in the last video, I got a lot of comments wanting information on specific markets. So I wanted to talk about some of these. And with that, let's start talking about Las Vegas. The way I'm going to be going over these cities is by comparing the median local home price in relation to the local median household income. You can see from this chart I have here that home prices in general are around 5 to 5.5 times the local median household income. This can change a bit depending on the market, but let's just use that as a general rule for the markets I'll be covering today. So for Las Vegas, the median home price is currently $447,597, and that's up 26% just in the last year. That's even with interest rates going up a few percent this year. Now, their median household income is only $58,377. That makes the median home price in Las Vegas 7.7 times the median household income. So you can see Las Vegas is well over that 5.5 local wages number. Couple that with their surging inventory and the highest interest rates we've seen in the last 20 years, and I'd say it's still not a good time to buy. Okay, somebody asked about Tampa, Florida. I used to live in Tampa when I was in grad school. I love that city. The median home price there is $420,316, and the median household income in the area is $55,634. That makes homes a 7.5% multiple over local wages. They also are having a massive surge in inventory. So again, this is a market that looks like it's going to have a crash or some type of correction. Someone also asked about Celebration, Florida. Here the median house price is $505,000, which is way down from its high in May of $635,000. And the median household income in that city is $87,323. That makes homes a 5.7x multiple over the local wages. Now, this assumes that wage data is correct. Sometimes small towns that don't have a large sample size don't give a very good picture of what's going on in the market. Prices there were in the low 400s just a year ago, so it wouldn't surprise me if they hit those numbers again if there was an overall crash in the Orlando-Kissimmee area. But it's tough to say. Maybe there's been more luxury homes built in the area that account for the increase in prices. That's something you'd have to look at. How has the price per square foot changed over the last 3 to 5 years, and what's the quality of new home construction there? Next, someone asked about Dallas-Fort Worth area, and I'll just tell you right now, this housing market is in trouble. One of the things you have to remember though is this is a large metro area, so prices change and inventory may not affect every neighborhood the same. So the median home price is $397,905, and the median household income is $54,747. That makes homes a 7.3x multiple over local wages. And if you guys want to get an idea of what maybe the market could get down to, you could take the household wage number I give you for an area and simply multiply it by 5.5. And I know these are general estimates, but you're never going to be able to predict the exact bottom of a housing correction or a housing crash. Okay, someone wanted to know about Phoenix, Arizona. That's another one of those housing markets that essentially everyone knows is in trouble. They've had a huge spike in inventory the last couple months. There were a lot of investors that bought into the city that are now leaving. The median home price in Phoenix is $434,879 right now, and the average household makes $60,914. That makes homes a 7.1x multiple to wages in the area. So this method I just showed you with regards to income to home prices doesn't take into account interest rates. So it's more of a quick and dirty way to quickly evaluate a specific market, but you can see it gives you a pretty good indicator without a ton of calculations. When we figured out the average housing affordability, we came up with homes being 39% overpriced compared to the long-term average. Well, depending on if you do a 5 times or a 5.5 times multiple on household income, you can see prices in a lot of these markets hit that 30 to 40% overvalued range. So again, you're probably wondering, is the bubble going to burst? Well, the reason it hasn't in the last 15 years is because the Fed used quantitative easing measures to prevent a crash. Now, it looks like those same tools they used before are no longer an option. If you're not against hitting that like button, go ahead and give it a tap. Also hit subscribe. I'll have more real estate market news for you guys. Go ahead and watch this video where I go over other housing markets, and you guys have a great day.